Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for January 7th of 2023. This being our first broadcast of the new year, and we're going to kind of take a look at a summary of what happened in 2022. Obviously, it was a very difficult year in the investment markets. We'll take a look at that, kind of the current backdrop and some of the key issues that we're looking at here in the early going of 2023. Please see our disclaimer for important information. All right, as we get started this week in our reflection of 2022, what I thought I'd show you here is an asset class return chart over a number of years dating back to 2008. And this is what they call a heat map. And so it breaks down the performance numbers for each particular major asset class. And it ranks them from top to bottom. So obviously the ones on the top were the ones that performed the best out of the entire group for the year, and the ones at the bottom perform the least. And you can see I've highlighted 2022, and this will kind of make sense as we go through it here a little bit. So you look at the very top, there's commodities up 16.1%, cash up 1.5%. Those were the only two major asset classes that had positive performances for the year. And we know how bad the equity market performed. We know how bad fixed income performed, and we'll show you the magnitude of that in the next two slides. But look at high yield bonds down 12.7%, fixed income itself down 13%, and then developed market equities, that's international, down 14%. Large cap domestic stocks were down 18%. Emerging market equities were down almost 20%, as were U.S. small cap stocks, and then real estate investment trusts were down over 25%. Now, one takeaway from this, outside of the fact that 2022 was a dismal year for most asset classes, is the fact that from one year to the next, you see different leadership in the market, and it depends on where you are in the economic cycle, and also where you are in kind of the overall, economic backdrop. Obviously, we had inflation last year, and so inflation is not conducive for equity market appreciation. But you can see here, some years REITs, real estate investments trusts, have led. Some years small caps have led. Large caps led in 2019. Some years like 2018, where you don't have particularly good markets, cash actually leads. So that may seem kind of strange to some people, but that actually does happen every once in a while. And you can see here, before we leave this chart, just accept the kind of the dynamic that from one year to the next, you do have changes in overall investment market leadership. So in the last slide, we saw how most asset classes in 2022 were negative. And this slide will show you just how rare the situation was last year and how difficult it was to manage money last year, in the sense that both stocks and bonds, you didn't get any benefit from diversification. Gold at one point was down 12% for the year, but this is a dot plot of annual returns. It's a plot of annual returns of the S&P 500 equity market index and the U.S. 10-year Treasury bond return for each year since 1872. And think about that. That is 150 years essentially worth of data here. And the enormity of this is such that I had to highlight 2022 and add this note at the bottom. This is the first time in all of these occurrences dating back to 1872 where the S&P 500 and the 10-year Treasury lost more than 10% on a total return basis for a full year. And you can see all these plots here. And so intuitively, the upper right-hand corner represents all of those years in which both stocks and bonds were up. And you can see here that's the majority. So we know that stocks typically go up, bonds typically perform positively, and really rarely do we see a negative return for U.S. Treasuries, but it has happened. And but usually, when one side of the market, equities or fixed income, is down, the other side is up if they're not both going up together. And so you can see that here, but in the lower left quadrant, that represents the years in which both stocks and bonds were down. And we can see here, you got to go back to 1969. That was an interesting year. And then before that, we have 1917, 1907. There was a major banking crisis and economic crisis in 07. 1931 is a Great Depression. And then we have 2022 over there on the far lower left. And you can just see, I had to highlight that because it's so extremely rare to have happen what happened last year. And here's a plot of a lot of the same data. The axes have been reversed. So instead of the S&P 500 annual performance being on the vertical axis, it's now on the horizontal axis. This chart is from Bloomberg. So it's a different source, but it plots the same data only since World War II. So again, the last one went back to 1872, 150 years. This one just goes back to World War II. And, basically a similar type backdrop here that, generally speaking, in most years, you're going to have positive performance from both stocks and bonds. Every once in a while, you'll have one or the other be negative, but generally speaking, you'll have the other one that's not negative be positive. But if you look at this chart, since World War II, the only other year where we had stocks and bonds negative in terms of total performance is 1969. And just think about that. That is an amazing statistic. And then here we are in 2022, with this incredibly weak performance in both sectors. So just again, something that kind of brings it a little bit more current, kind of takes some of the data points out of it. And so if you look essentially since World War II, this has been a pretty bad year, relatively speaking. So digging down onto the equity side, I thought I'd show you this attribution analysis by factor. And so not all boats sank at the same degree in the equity market. And for simplicity's sake, I just took large cap factors here and kind of illustrate what worked and what didn't work. I highlighted really the areas that helped the market. These actually happen to be areas that we emphasized in our own investments. Low valuation performed extremely well, regardless if you did price to cash flow or price to earnings, price to book or price to operating earnings, is known as EBITDA. Yield, so dividend yield actually performed exceedingly well, and then high quality also performed very well. And what you see here, outside of that were areas that did not do well. Growth performed awful last year. You think about all of the technology companies that lost a tremendous amount of market capitalization. Growth and high valuation, these so-called long duration stocks, really took it on the chin last year. And unfortunately, the overall market, as we very well know, was down 20% if you use the S&P 500 as a proxy for quote unquote the market. But you do see here that there were pockets of the market that did perform well. So looking at the market by sector, and again, we're looking at the S&P 500 index. You can see the index itself was down at the bottom here. I've highlighted this, down 20% for the year. And over 5 and 10 years, you can see it's up 48% in the aggregate. Over 5 years and over 10 years, up 174% in the aggregate. Again, long-term trends, very much positive for the equity market. So as much pain as as we all felt last year in the equity markets, just know that there's a very strong long-term upward bias in performance in the equity market. So let's not try to get, as we try to, get 2022 in the rearview mirror, just know that over a longer haul, that, these markets are definitely positive. And you can see this, regardless of the sector. So obviously looking at 2022, energy was up 59%, which was really the only part of the market that did well. Market, if you accepted energy, would have been down, probably closer to 25% ish. based on the weight of energy. But you look at over 5 and 10 years, all these sectors are up. Some of them very strong. Obviously last year, technology, consumer discretionary. Just think about that. High inflation really ate into consumer budgets. People started putting money on credit cards, and they were continuing to try to spend, but they were chewing through their savings and charging up their credit cards to support their spending habits. But consumer discretionary still took it on the chin, as did telecom, communication services, real estate, materials, financials. I mean, all of these areas were negative. But then, you look over a longer period of time, technology has done exceedingly well. Healthcare, interestingly enough, has done exceedingly well. And you can see all of these areas positive for these time frames. So we got a couple of charts here on Fed funds rate, short-term interest rates. A lot of speculation heading into the new year. What is the Fed going to do? When are they going to start slowing their rate increases? I can tell you that the rhetoric really from the Fed hasn't changed. We'll see here in a minute that financial conditions have actually eased up, which is kind of confounding the message, and the Fed is kind of frustrated at that. So there's been a lot of speculation as far as what's going to be the peak and the trend and the outlook for short-term interest rates. And you can see here, as we head into 2023, the Fed funds rate is now about 4.4%. So that is the most current, as basically zero maturity money. So about 4.4%. You can see the trajectory, you see where we've come from, you see prior rate tightening cycles, and the fact that, we hit the pandemic there in 2020 and rates went to zero, and now you see this meteoric rise in rates. And so, basically the year-end estimate, the dot plot, if you will, from the Federal Reserve, from the voting members, suggests that the peak rate will be about 5.1%. That's very consistent with Wall Street. Now, just keep in mind, though, that when we entered last year, this time a year ago, that dot plot said that the Fed funds rate was going to be at 0.9% by year end. So obviously they were very, very, very much wrong. So take this with a grain of salt to some degree, but this is market expectations are in green. The Fed expectations are in the blue diamonds here. And so you see, whether it's 4.6 for the market, 5.1 for the Fed, you can see that rates are expected to move lower as we head into 2024 and into 2025 with a terminal rate of around 2.5%. So just note that it'll take a while for us to get there. So this is the market implied terminal rate as it stood literally as of Friday. And so I think it was a little bit higher in this chart than it was in the prior chart, but it's obviously been a moving target. You can see here. Right now, that number stands around 5%. So if we're around 4.4 in Fed funds rate, or essentially a money market rate, if you will, the feeling is that we're going to top out around 5%. So as we go back to 1788, a long time ago, and we look at annual moves in the 10-year Treasury rate. Now, this isn't performance. This is the actual change in rates. We have had 2022. We had about a 2.3, 2.4% move in rates, and honestly, it the rates on shorter term rates were actually much higher. But this is a 10-year yield. Moving up about 2.25%, 2.3-ish. And that's the biggest move that we've seen in a 10-year Treasury since 1788. And here's a plot of all these other years that kind of fall next in line and third in line, so on and so forth. In the dark blue, that's the annual 10-year Treasury rate move. And then the light blue represents what happened with those rates the following year. And you can see here, there were some years, like 1980, that the rates kept moving up, but more often than not, rates reversed. And so that is a feeling that is embedded in the markets right now. So you look at short-term rates. Obviously, we just talked about Fed funds rate at 4.4. You've got 10-year yields since we have an inverted yield curve. So we have a 10-year yield that's below that. And so even though this rate has moved up more than it has since 1788, there's a general better than 0% chance that maybe rates move back down. That is the conventional wisdom right now. And so that's what's baked into the market, that inflation is going to slow. And we'll show you some charts that indicates that it is that the inputs to inflation should continue to help drive inflation lower. And if that's the case, then yes, I think there's a case to be made for perhaps interest rates to move a different direction in 2023. Here's a quick check on volatility, and I don't have to tell anybody that's listening to this that volatility was high, but it was high in a lot of different areas. Now, you think about volatility, most people kind of equate that to the stock market, and obviously the S&P 500 VIX is kind of the volatility indicator there, and it was high. But I want to tell you that we actually had more volatility in the fixed income markets. So we had more volatility in interest rates last year. And we even had volatility in the currency markets, even though we know that the dollar was exceedingly strong for the entire year. It weakened up a little bit at the end of the year, but overall volatility in all of these markets was relatively high. And you've got to go back to the global financial crisis. You see here 2008, 2009, to get volatility levels that were as high as they were last year. Now, we've talked a lot about the traditional 60-40 portfolio, and I'm leaning on JP Morgan. They had their latest chart pack was really good and illustrative. So credit to JP Morgan for a lot of this data here. But, we've talked about the 60-40 portfolio, and again, how challenging it was last year because stocks and bonds were down by a great amount. Gold was not helpful, all this stuff. So this is from 1950, and it shows you, again, like we showed in the dot plots, or excuse me, in the scatter plots, that most years are up for both equities and fixed income. Oftentimes, or sometimes you'll see, one or the other down, but not generally both like we saw this year. And you can see that here, in these various occurrences where, equity markets, which tend to be much more volatile than fixed income, we know that. And that's why we own fixed income in a lot of diversified portfolios, because it's supposed to help offset that. You see here in a lot of these instances where equities were down by a fair amount, but then fixed income went the other way here. And you see in 2022 that 60-40 balanced portfolio was down 16%. Now, fortunately, our portfolios were not down that much because of some of the emphasis on dividends and short-term maturities on fixed income and other things like that. But the market itself was really challenged. But I just want to show this chart to emphasize that most years you don't have this, and you tend to get these moving in the same direction more often than not. This is a chart again from JP Morgan, a little busy here, but it plots consumer sentiment and subsequent 12-month S&P 500 returns. Now, obviously exiting the year, we know that sentiment was fairly low, and its sentiment numbers are much more, this University of Michigan sentiment number is much more influenced by what's going on with inflation. So when inflation's high, the questions that are embedded in this survey tend to flush out a much weaker result for sentiment. And that has certainly been the case here. And you can see going back to 1971, these troughs in consumer sentiment. And then in the blue, it shows you what happened in the equity markets in the 12 months after. And so it also shows you what happens when that sentiment peaks too. And so you can see here, in these 8 sentiment troughs that are accounted for here since 1971, that the average subsequent 12-month S&P 500 return is about 25%. Now, that's not to say that we're going to have 25% return in the equity markets this year. I think If it's positive, it will be perhaps a third of that, maybe. But again, we're very early on, and there's a lot of known unknowns out there. But suffice it to say, that typically when you hit a trough of sentiment, that you have a positive return that next year. And so you can see here, going back to 1975, market 12 months later was up 22%. May 1980, market was up 20%. 12 months later, 1990, 29%. And then after the global financial crisis, November 2008, it was up 22%. And then another 15.4% there in August of 2011. And so, again, a fairly meaningful relationship here between these two. And I think something that should hopefully give us a little bit of optimism heading forward. So clearly, one of the big issues heading into 2023 here is the earnings picture for the S&P 500. So obviously, when we talk about valuation, we're talking about the price to earnings ratio. And if earnings go down, then that kind of artificially inflates the price to earnings ratio, which is the measure of what valuation is. And so valuation moves higher as earnings move lower. And so obviously we're very concerned with the pace of earnings, and a lot of rhetoric right now that earnings are slowing. I think that's accurate. I think it's hard to imagine companies shouldering the burden of decreased demand in a lot of areas with some of these higher cost inputs, even though costs are moving lower. We've got a couple charts on that. But still, I think there is definitely a feeling here that earnings are going to slow. But we want to take a look at the historical backdrop going back to the beginning of this century, actually, 2001. You can see here, obviously we've had years in which margins have accounted for a fair amount of the drop. When you think about, weak economic periods like 2001, 2008, margins dropped quite a bit. And then the green represents, that's in the gray. So the green represents revenue. And, generally speaking, revenues are up, and revenues were actually up in 2021 and 2022. But again, you saw profitability begin to erode last year. And that's why we had a negative overall earnings result for 2022, primarily because higher costs were impacting margins, profit margins, and offsetting that revenue figure. And we think that trend probably continues into 2023, and the fact that we probably get less upside benefit from revenues just because we're in a slowing economy here. Now let's talk about valuation. And again, I love statistics and data, and these are two dot plots that take us back to 1990. And this is monthly data, just to be clear. That's why there's so many data points here. And you see this line of best fits, so on and so forth. So, and the red dotted line represents where the valuation is of the S&P 500 now. When I talk about price to earnings ratio, that ratio itself is just about 16.5%. And that's really close to kind of a long-term average. So if you look at the intersection of this line of best fit and where we are in terms of valuation, the top represents, historically speaking, when we're at this valuation, the dots represent the subsequent 5-year returns. And down below, you see the subsequent 10-year returns. Again, for where we are in the market today in terms of valuation. Last slide we talked about the risk of earnings erosion, but where we are right now, just forget about the trends in earnings, just take stock of where we are now in valuation. Typically speaking, again, there's some variance. So there's not as much correlation over 5 years as there is over 10 years. But, if you look over the next 10 years for younger clients that have longer term horizons, you can see that the 5-year, the 10-year return is going to be around, 6 to 7%. And the same goes maybe a little bit, 7 to 8% over 5 years based on today's valuation. I have a couple of things here which kind of give us a sense of what's going on inside the heads of both company management, C-suite executives that represent S&P 500 firms, as well as kind of the run-of-the-mill retail investor. And so on the left-hand side, we have insiders and what their sentiment is. So this is a data plot that comes to us from insidersentiment.com. I'm not terribly familiar with this particular research, but it is telling in the sense that sentiment is falling. This is a trailing 3-month number, so it's a little bit smoothed out as much as you can on trailing 3-month data, but you can clearly see that that's been moving down for a number of months now. Now, if you go over to the right-hand side, that's basically the purest manifestation of what the retail investor is thinking, and that is essentially what are they putting into the equity market, or retail net inflows into equities. And you can see that number is kind of in that purplish number, and you can see that has been trending down even during the month of December. And this is a monthly series just going back to the beginning of last year. You can see how that is eroded throughout the year as we've continued to witness these poor returns in the equity market. You can see the S&P 500 index overlaid in the light blue, and you can see where that kind of channels very similarly over a period of time. I'm going to pivot somewhat and show you something from BCA, which I thought was really kind of interesting here. This is a plot of economic surprise, the economic surprise index to net earnings revision. So we've been talking about the risk of earnings going down and the earnings estimates being revised lower. Well, in this time series from BCA, both in the U.S. and global, what we have seen lately is that the economic surprise index has actually moved higher. That's in the dark line there. We see that's moved higher both at the U.S. and the global level as of late, at a time where we see consistent net earnings revisions be negative. And so, suggestion here is that mean reverts at some point, and you do see earnings revisions slow and then maybe become positive. So that they're putting this question mark here to say, what if? Now, obviously, if you have economic surprises continue to be positive, again, the expectations are pretty weak, right? Global recession, blah, blah, blah. This is probably going to be one of the most anticipated recessions in the history of the United States. But if some of these surprises are positive surprises continue, that at some point you're going to have these earnings revisions these negative earnings revisions begin to slow and then maybe even turn positive. And if you have that, that is an extremely powerful engine for equity market movement. Quick look at the economic growth and a breakdown of GDP, which I always think is helpful because I always talk about how the consumer is, consumption in general is 2/3 to 70% of the economy. You can clearly see that on the right-hand side. You can see these other components. Net exports and trade is a moving target. Sometimes it is negative, sometimes it's positive. Net exports, particularly if you count China, is usually negative, but government spending and investment are both contributors, as well as housing, which is kind of uniquely broken out here. Usually that's tied up in investment, but you can see on the left-hand side, our actual GDP year-over-year movement, what our trend line growth is. Again, it's not terribly robust. It's 2%, and for many years we were, kind of trailing below that. And then we had the pandemic, and then we've had this great acceleration, if you will. But where we are in terms of our economic growth, we're actually below our trend line right now. And so, if we have this recession next year, there's probably a decent chance, if we're only looking at maybe 1% to maybe 2% or 0% to 2%, I'll call it, in terms of economic growth for 2023, that would keep us below that trend line. Here's the financial conditions index, and this is what I was referring to earlier. This is actually giving the Fed a lot of heartache right now because I've got two different representations of financial conditions from two different providers. Even though these arrows are moving in different directions, they're moving in the same way based on how this is calculated. So let me just focus on the left. This is from Bloomberg Financial Conditions Index. So anything that moves higher or trends higher represents easing financial conditions. And that's clearly been the case since October. And we're not quite positive in terms of this index, but we're moving in that direction. And so this represents conditions easing. That's not what the Fed wants. They want tightening conditions. They want conditions to be tougher. They want to slow the economy down. They want to increase unemployment, so on and so forth. On the right-hand side, we have a Morgan Stanley index it's moving down, but that's a cumulative change in financial conditions. So what it means is if things are moving down, that represents easing financial conditions. Again, the same thing that the Bloomberg survey is doing to us. And this is really making it hard for the Fed to come to a conclusion about slowing their pace of increased interest rates. And this is what really leads me to think that, we might see, 25 or, maybe 50 basis points in the next meeting, followed by 25 and 25 and maybe another 25 before they slow down. This is all kind of coalescing around this thought that we're going to have maybe 5 to 5.1%, a terminal rate in short-term Fed funds rates. Well, now we'll talk about high frequency data. So, again, for all the negative things that you can say about maybe where the economy's going, and there are some, clearly some trend lines that we're watching that are negative, that are evidencing this slowdown that we've been talking about and greatly anticipating for quite some time. But there are pockets of what's going on that are actually pretty amazing. So you've seen this table quite a few times over the last year. But we look at changes relative to 2019, so that takes us to that year prior to the pandemic. You look at things like hotel occupancy, open table restaurant reservations, TSA checkpoint data, which was terrible. Obviously, there was no travel during the pandemic, but relative to 2019, you see that those are positive, and actually they have been positive, with the exception of hotel occupancy, but for over the last month. Now, supply of motor gasoline, we know people just aren't traveling as much, although there's been this reopening, and we know commercial flights, the actual supply of flights and seats has gone down. But overall, I mean, we've seen some positive signs here. Rail car traffic is still down, as is steel production relative to 2019. And those numbers are getting weaker as the economy is getting weaker, but there are green shoots here relative to 2019. And for a long time we were looking at this table, and most of the column change since 2019 was in the red. And so it's nice to see, despite all this rhetoric about a slowing economy, that we have elements of the economy that are performing better than they were in 2019 before the pandemic. Now we'll dig into some of this data that's trending lower. We see here, and I've highlighted this, the Institute for Supply Management Services Index. Again, services is more meaningful to us than the manufacturing index, although from a kind of like a psychological standpoint, maybe that's not the case. But for the first time here since the pandemic, we've seen that number turn negative. So anything below 50 represents contraction. And so we just saw that here in the last data point. So that may be habit forming. I think this is evidence, and we'll show you kind of correlations, why this is important, that ISM services is going down. And we see now on the right-hand side, we see prices moving down lower. So this is positive. So, again, left side is negative in terms of activity slowing. Right side is positive in terms of prices moving lower, which is something we definitely want to see. Here's the manufacturing index, which is the other side of this. Again, service is more important. Manufacturing is still important, though. We do see overall index here is in contraction territory. That's on the left-hand side. New orders are negative, so we see contraction, not a surprise. We expected this. Right-hand side, we see deliveries and prices both moving lower. So deliveries, that trending negative is actually in some cases a positive because we have lower demand, but the supply chain choke points have really eased up. We're not hearing nearly as much of that as we did this time last year. And then prices moving lower for manufacturing, as well as we just saw in the last slide for services, both very positive in terms of building our expectations for future inflation. So here's ISM manufacturing data, kind of revisited here, if you will, just to kind of put underscore the point here that I'm making with regard to some of these trends and prices and lead times and things like that. I mean, clearly there is a slowing going on, and we know that it's very highly anticipated, like I've been talking about. And so we see that here, prices paid. But I put this up here and kind of repeat this point because the estimate was for it to be negative, and prices actually came in lower than that. And they surprised positively to the downside, which is really encouraging for the inflation backdrop, looking down the road several months. And then, as I mentioned, from a supply chain standpoint, with the slowing in demand, these supply chains have really eased up, and that's on the right-hand side. You see a massive change in a relatively short period of time on lead times for suppliers. And so, again, all very, very positive, considering that, that supply chain choke points were a pretty strong contributor to inflation early on. I have two interesting correlations that I alluded to before on this particular chart, and both of them relate to the ISM manufacturing numbers, which we've been, just talking about here. And so on the left-hand side, we plot that ISM number on a 3-month leading basis against consumer prices in the commodity sector. And again, let's be clear that this is not consumer price index. These are actually the commodity prices that are reflected within that basket. And you see there's a really tight relationship there. And what's clearly indicated here is that the ISM manufacturing prices paid is rolling lower. Again, we saw that in the last slide. We know it's moving in the right direction. And ultimately what this suggests is that commodity prices are going to follow in that CPI basket. Again, disinflationary, which is what we want to see. We want the sooner that we can get inflation down, the sooner the Fed can kind of take their foot off the gas pedal and we can reemerge into a new economic cycle. Well, looking on the right-hand side, there's ISM manufacturing, again, on a 3-month leading basis, and then overall CPI inflation, not just commodities, but overall CPI. And you can see, that number in the white there, we know inflation's rolling over. It's still very high. A lot of question entering the new year as far as like how long it's going to take for inflation to come down. We know it's likely to remain high, maybe 4.5%, 5% for the balance of this year. Who knows? But we know it's high, but it's coming down. And you see that green line, which is the ISM manufacturing on that 3-month leading basis. And that is clearly telling us that inflation is going to continue to fall. These are really positive numbers, in my opinion. There's a couple of slides out of the high frequency data, looking at year-over-year basis. On the one hand, you can see staffing, and the green line represents 2022. The dark blue line represents 2021. We know that staffing is rolling over a little bit, and relative to 2021, we can see that trend. It's kind of really on top of what 2021 is. So in other words, it's not terribly strong. There is some seasonality built into this, but labor overall remains pretty strong. Weekly retail sales, we can look at 2022 and we can see the impact of inflation on that. And so you look at 2021 and 2022, and you can see that divergence there, particularly as we got through the second half of the year, clearly an indication of the impact of inflation on overall sales, even though overall consumption remains fairly high. Now we're going to transition into a lot of labor data because I think labor is really important heading into the new year because it's something that the Fed wants to slow down. They want to slow down the labor market. We see non-farm payrolls monthly change. You can see the trend line here throughout 2022. That's moving down. It's still above its pre-pandemic average, which is it's confounding the Fed, but it's moving in the direction that they want it to. So in other words, that pink bar, December, we had 223,000. That's still above that pre-pandemic average. It just highlights that the labor market's very strong, which is an unusual place to be if you think that you're like on the eve of recession. Well, and looking on the right-hand side, unemployment rate is 3.5%. I mean, that matches the low that we haven't seen since the late 1960s. Again, labor market exceptionally strong here. Again, looking at the labor market data in a lot of different windows here. So we've got average hourly earnings. This is important because inflation and wages is very sticky, but average hourly earnings for private sector workers, a 12-month change here, rolling over. That's a good sign. We like to see that. That's in the upper left-hand. Lower left-hand side, we get average work weeks trending lower. That's an interesting development. So workers are being asked to work less because demand is off. And look at the labor force, the share of share of the population that's in the labor force, has certainly moved up over the pandemic. But if you look at that line pre-recession, we're not there yet. And there's nothing to indicate that we're going to have a surge in participation, which you would want to see. Now, this is kind of an offset that if you had a surge in participation, you'd have wage growth go through the floor. And that would obviously be positive for inflation. But I think the one gotcha in all this, even though that average hourly earnings are moving lower, is that the labor force participation is not moving fast enough to help accelerate that, I guess. And then the lower right-hand side is just overtime at manufacturers, and overtime is falling off a cliff just because demand is slowing there. Job openings rolling over, but if you look at this time series dating back to 2005, particularly after the global financial crisis in 08, 09, you can see that the trajectory has been considerably positive here, and we're still at extremely elevated levels here in terms of job openings. So, but it's good to see, at least from the Fed's perspective, or looking at it through their lens, that job openings are going down. But that doesn't mean that the labor market is quote unquote weak. We do see regionally that the job openings are going down quite a bit as well. Here's job openings for on the left-hand side. We've got job openings divided by the unemployment level. So this is a measure of how many jobs are out there for every unemployed worker. And so this is an emphasis to my point that even though we see job openings overall roll over, it is certainly not indicative of a weak labor market. And because here we see this, and this data series goes back to 2001, there's still 1.7 jobs available for every unemployed worker. That's a pretty stout market. And then over on the right-hand side, we've got the quits rate relative to hires. So for what this shows you, the latest data point, it's at 0.7. What that means is for every worker that is hired, there's, let me put it in these terms, for every 10 workers that are hired, there are 7 that are quitting. And so this is representative of a very fluid and still robust labor market. And I thought this was extremely interesting here. This will be the last slide on related to labor, but this ties back to the equity markets and ties back to stocks here. And so this is looking at different time periods. I mean, in this this olive color here, you've got all of these data points plotting the job openings rate to the Russell 3000 equity index And then in kind of the light blue, you've got 2010 to 2019, and then the pink dots represent after the pandemic. And you can see this trend line. So there's actually the takeaway here is that there's a positive relationship between the job openings rate and earnings, which makes sense. So if you have more job openings, then that's symptomatic of a healthier environment that employers are hiring, and you tend to have higher earnings as a result of it. And so, so as we look at the labor market, and this is probably one of the slides I saw that kind of led me to think that I needed to have more labor discussion in this particular chart pack entering the new year, because labor is going to be important to track and actually can help us be a little bit of a leading indicator for earnings. And this is one reason why I think that if we have this recession, it's not going to be as robust as some fear. I think it'll be a mild recession. You've got national income that's just too strong. The labor market's just too strong for there to be a really significant economic downturn, in my opinion. Last two slides here, a lot of conversation over Russia's invasion of Ukraine and this deep winter that was going to cause a lot of disruption in the energy markets and a huge spike in prices and a huge cratering in the European economy because people are having to spend more for natural gas. Well, guess what? They've had an unusually warm winter, and I put the picture on the right-hand side is actually a ski resort somewhere in the European Alps, and they're having to make snow, and you can see that there's not much snow on the slopes right now, and as a result, natural gas prices have really taken a deep dive, which I think in some respects is maybe causing us to revisit a little bit our thinking on the European space and on international altogether. And then finally, a little bit more of a secular trend that kind of caught my eye in some BCA research, and they just do wonderful work on this type of stuff. China total births are rolling over. You can see that working age population projections are probably close to their peak right now. And you look at China and its 100-year strategy to kind of become the dominant economic engine of the world. You just see that, based on current birth rates and trends, not that the U.S. is replacing workers either, and we have a huge immigration conundrum right now, but, just looking at China being that engine of future growth, as you look out over 10, 20, and 30 years, it just doesn't look that way. Well, that's what we have this week. I hope you've enjoyed it. A little bit longer chart pack this week because I think it was really important to kind of unpack some of the issues, drivers, and anchors to what happened last year as we enter the new year. And appreciate your thoughts. And please reach us at the information below. Hope you have a wonderful week, and we'll see you again soon. Take care. Bye.